Welcome back to the Daily Crypto Roundup, the show that keeps you plugged into what's actually happening in the market right now, not what people wish was happening. Today is one of those days where the mood is a bit heavier again. We had the big flush at the start of the week. We didn't get a convincing recovery yesterday, and today we've seen another dip across the board. So instead of pretending everything has suddenly turned bullish again, we're going to talk honestly about what's really driving this. Bitcoin starting to move differently to stocks. New warnings from the IMF about stablecoins, central banks messing with the macro picture, fresh liquidity being added in the background, big exchange news from Binance, a new wave of interest around XRP, politics in Poland, and even how Gen Z are still asking for crypto for Christmas despite all of this. Before we get into the stories, a massive thank you to everyone who's been rating the show 5 stars this week. Today is the day. We're announcing our Friday giveaway winners. One listener is taking home 10 XRP, and another is getting 5 XRP. The winners are King John III, 10 XRP, and Tom Collective, 5 XRP. We'll reply to your comments to get your address. Now, before we dive into the headlines, let's quickly check the market and see where everything is sitting right now. Bitcoin is trading at around $89,280, Ethereum is holding near $3,020, XRP is at $2.03, Solana is sitting around $132, Cardano is at 41 cents, Dogecoin is trading at 13.8 cents, BNB is just under $881, and Polkadot is currently around $2.11. The first thing we need to talk about is this idea that Bitcoin is starting to drift away from what stocks are doing. For most of the last decade, Bitcoin has moved in the same direction as big stock indices like the S&P 500 and the Nasdaq. If stocks were up, Bitcoin usually did well. If stocks were scared, Bitcoin normally dumped hard with them. That link is what a lot of macro traders have relied on. But now we've got a strange split. Stock markets have been holding up and even pushing higher in some regions, while Bitcoin has had one of its weakest patches of the year, including that big drop earlier in the week and the additional dip today. In simple terms, that means the old Bitcoin just follows the stock market story isn't working the way it used to, at least in the short term. Some analysts think this is because a lot of the hot money that ran into Bitcoin earlier in the year has now unwound, while the stock market is still being supported by different factors like specific big tech names or expectations of future rate cuts. Others think it's just a timing issue. Stocks reacted to good news first. Crypto is lagging and still digesting the earlier hype. Either way, the important takeaway for you as a listener is this. You can't just assume that if stocks are green, Bitcoin will automatically be green as well. The relationship is getting more complicated. That ties straight into the next point, which is today's dip itself. Bitcoin has slid back towards that 90,000 area ahead of important US inflation data and the next Federal Reserve decision. Traders are nervous because those two things decide whether interest rates stay high or start coming down. If rates stay higher for longer, risk assets like crypto tend to struggle. If there's a clear sign of cuts coming sooner, markets can breathe. Right now, it's neither one nor the other. It's a lot of waiting and guessing. That's why you're seeing these shaky sessions where we drop, try to stabilize, and then drop a bit more. There hasn't been a clean recovery day to wash away the fear from the start of the week. On top of that, you've got pressure coming from the other side of the world. The Bank of Japan is hinting that it might raise interest rates again. That sounds like a purely Japanese story, but it actually hits global markets hard because of something called the yen carry trade. The simple version is this. For years, big investors have borrowed cheaply in Japanese yen and then used that money to buy riskier assets like US stocks, tech names, and yes, Bitcoin. If Japan raises rates, that trade becomes less attractive. Investors have to unwind it, which means selling those risk assets and paying back the yen. That's why you see people in crypto talking about Japan even if they've never traded a Japanese asset in their lives. If the carry trade starts to unwind in a big way, you can get sudden, brutal moves lower in things like Bitcoin, without anything being wrong with Bitcoin itself. It's just macro plumbing slamming into crypto. Now here's the weird part. While all of this is happening, the US Federal Reserve has just pushed over $13.5 billion of new liquidity into the system through short-term lending operations. That's a huge number. On paper, it should support risk assets like crypto because it's basically fresh fuel entering the market. Some people have jumped straight to saying, right, that's it, Bitcoin is going to fly. But so far, the price is telling a different story. With today's dip, what we're seeing instead is more like a stalemate. The extra liquidity is there in the background, but the fear around inflation, rate decisions, and things like the yen carry trade is still strong enough to keep buyers cautious. In other words, the fuel is in the tank, but nobody has turned the key yet. We are going to pause here for a quick word from our sponsors. Stay with us.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
Let's move from macro to regulation for a minute, because the IMF just dropped a report that absolutely slams stablecoins. The message from the IMF is pretty blunt. They are worried that dollar-linked stablecoins could weaken local currencies, especially in countries that already have fragile economies or high inflation. They don't want stablecoins becoming a sort of unofficial replacement for national money. The report argues that if people in those countries start using dollar stablecoins for everything, the local central bank loses control. That's why the IMF is calling for much stricter and more coordinated rules globally. They want governments and regulators around the world to get on the same page and clamp down before stablecoins get too big. For anyone listening who holds USDT, USDC, or any other major stablecoin, this doesn't mean they're going to vanish tomorrow. But it does mean the pressure for tighter regulation is increasing. Over the next few years, we're likely to see more rules about where stablecoins can be used, how they're backed, what kind of audits are required, and who is allowed to issue them. It's a reminder that stablecoins are not some risk-free parking spot. They live at the intersection of crypto and traditional finance, and that intersection is getting busier and more heavily policed. We're also seeing politics collide with crypto regulation in Europe. In Poland, the parliament has just refused to override the president's veto of a new crypto law. The government wanted to bring in tougher rules, partly to align with the European Union's Big MiCA regulation, and partly over national security concerns, including worries about Russian use of crypto. The president and his allies argued that the proposed rules were too heavy-handed and would drive crypto businesses away. The government didn't get the supermajority it needed to overturn that veto, so the law is dead for now. What does that mean for you? It shows how messy and inconsistent crypto rules still are, even inside the same region. One EU country pushes hard for more oversight, another pushes back. Some firms like that because they can set up shop where rules are lighter. Others hate it because they want clarity and stable rules to build long-term businesses. For regular users, it just adds another layer of uncertainty. The direction of travel is still towards more regulation overall, but the path is bumpy and political. Now let's shift to one of the biggest players in the industry, Binance. The exchange has just appointed co-founder Yi He as co-CEO, sharing the top job. This isn't just a cosmetic change. Binance is under heavy scrutiny from regulators around the world, and the company is trying to show that it has grown up from its early move fast and break things days into something more structured, with clearer leadership and more focus on compliance. The fact that they're making this move while also pushing towards around 300 million registered users tells you how huge they are. Love them or hate them, Binance is still a central piece of the crypto ecosystem. For listeners, the main angle here is simple. Exchanges are now global financial institutions, not just random websites where you swap coins. Leadership changes at that level matter. They can affect how aggressive an exchange is, how much they focus on new products versus regulation, and how they respond to crises. So when you see headlines about Binance, Coinbase, Kraken, or any other major exchange changing CEOs or reorganizing, it's worth paying attention. That's the infrastructure your crypto sits on if you're not fully self-custodied. Let's talk altcoins for a moment, because even in this kind of market, people are still hunting for the next big thing. A lot of attention right now is on XRP again, with some analysts and commentators arguing that it could be one of the better coins to accumulate going into 2026. The pitch is that it has a clear use case around payments, a strong existing community, ongoing institutional interest, and that the regulatory cloud hanging over it has been reduced compared to a couple of years ago. None of that guarantees price performance, and this is not financial advice. But it's interesting to see which names keep coming back into focus whenever the market starts to think about the next cycle, rather than just the next day's candle. The broader point here is that even on red days, capital is still thinking in cycles. People are looking at which coins have real narratives, real adoption, or real infrastructure behind them that can survive these kinds of drawdowns. Bitcoin is still the main driver, but altcoin stories haven't died. They just get quieter when everyone is staring at the BTC chart. Let's zoom back out to the human side, because there's one story that cuts through all of this price noise. Surveys are showing that a huge chunk of Gen Z still want crypto as a Christmas present. Roughly half of younger adults in some polls say they'd be happy to receive crypto as a gift, and a sizable percentage are even planning to spend with it over the holidays. That's pretty wild when you remember how much volatility we've just had, and how many scary red candles people have seen. What that tells you is that culturally, crypto isn't going away. For younger people, it's part of how they think about money, investing, and even identity. They might not be interested in owning a random stock, but they're happy to take a bit of Bitcoin, Ethereum, XRP, or Solana under the tree. It doesn't mean everyone will be profitable or that they fully understand the risks, but it does mean this industry still has a powerful pull on the next generation. So where does all of that leave us at the end of today? We've got Bitcoin dipping again and failing to put in a clean recovery yet, while stocks in some places are still marching higher. The old link between crypto and equities is wobbling. We've got a big central bank in Japan threatening to pull one of the major supports from under global risk trades. We've got the US Federal Reserve quietly pumping liquidity back into the system, but the market hasn't decided to fully trust it yet. We've got the IMF warning loudly about stablecoins and national currencies, and parliaments like Poland's fighting internally over how much control they should take. We've got Binance reshaping its leadership as it marches towards 300 million users. We've got renewed interest in XRP and other majors as people think ahead to the next leg of the cycle. And we've got Gen Z still asking for crypto for Christmas like nothing has changed. If there's one message I want you to take away from today, it's this. Today's dip doesn't erase the bigger picture, but it does remind you that crypto is still a macro-driven, regulation-sensitive, emotionally charged market. You don't need to chase every move, and you don't need to panic at every red candle. Your job is to stay informed, stay calm, and make decisions based on your own time horizon. Not just the last 24 hours of noise. If you're still listening at this point, you are absolutely part of the core of this community, and I appreciate you. Stay safe, stay curious, and as always, we will see you at the top.